My name is Joanne Bose. I will be serving as your moderator today. You'll be hearing a presentation from Bill Homa, but first we have a few comments. As usual, all phones should be unmuted or turned off. Bill needs no introductions. He is a beloved teacher and longtime CPA, RMA, CFO, CTC, and QPA. We are happy to welcome Bill back for an exciting rendition of non-cash transactions.
Yeah, you have to admit, this is exciting. One of the things when I was president of the GFOA in 2009 and 10, we had an early bird at 7:30 in the morning. How many people attended this 7:30? We had record attendance. Hopefully, put on your evaluations, you'd like to start at 7:30 in the morning. And when I was president, we used to have a twilight at 7:30 at night. Forget these things at the pier, you know what I mean? We can have a seminar at 7:30 at night, and it went well. The reason why we stopped it was on the evaluation, people wanted an open bar at the Twilight Seminar, and that didn't go over too well. So anyhow, welcome, and we're going to make it exciting. What I wanted to do was, they asked me the early bird came back, even though it's at 8:30, that's okay. And they asked me to do it, so look, I want to do something exciting, try to make it exciting. I don't want to make it boring. But one of the things that I do at Rutgers, I teach the financial statement classes. And one of the things we're trying to do is get all the CFOs to do their own financials. Shouldn't be the auditor's responsibility. It should be our responsibility. And one of the things that we all know is that I've seen in practice, if you have your general ledger up to date, everything journalized, gang, it makes the financials a breeze. And the thing I'm going to be focusing on today is all things that, as CFOs, we get from the tax office. Non-cash transactions that are generated from the tax office that we need to journalize into our general ledger. And that's what I'm going to be covering today. Like recording the levy and the annual tax sale and different things like that. So we're going to be covering all of those today. But, look, I was an auditor for 6 years, before I got on the other side of the desk. And back in the 70s, it used to drive me nuts when I was an auditor. I would go get the CFO's general ledger. They would have $500,000 in taxes receivable in the general ledger. I go get the trial balance from the tax collector, and it's $475,000. It's different. Why? Because there were non-cash transactions, adjustments that the collector was making to his or her tax screen that wasn't journalized in the general ledger. So we're going to be trying to focus in on that. And also part of the presentation, I'm going to try, I know there's only 50 minutes. Yeah, we're supposed to shut off the phones. I know there's only 50 minutes. I'm going to try to highlight where we get the transactions from. Look, I teach at Rutgers, and I'm guilty of it, and I give the number to somebody on a piece of paper. I give Patty the number on a piece of paper. She makes the journal entry. Well, gang, when you go back to your town hall, nobody's going to give you a piece of paper. Where do you find it, right? So we're going to try to highlight a little bit where we get the information from, all right? All right, let's see how this all works. Patience. Now, what I wanted to do was the Bill Homa show. Because, look, gang, when I came in here, I was hoping they'd have my picture, like in the lobby. Bill Homa, non-cash transaction. I come in, they got Paul Anka, they got Kenny G. I know, based on your age, they got the Amazing Kreskin. How many people remember the Amazing Kreskin? Maybe I'm showing my age. I don't know why the hell he didn't have my picture there with non-cash transactions, September 28th. So I'm a little bit disappointed with that, to be honest. I'm going to talk to management here. So I'm going to call this the Bill Homa Show. And what I'm going to do is, I'm also grabbing something from the David Letterman Show also. I'm going to have my top 10. I'm going to have my top 10 increases to the tax levy or receivable, and my top 10 decreases to the tax levy and or the taxes receivable, okay? So I'm going to do my top 10 list for both. First, what we're going to be doing is, here we go. These are going to be my top 10 increases to the tax levy or receivable. And then we'll get into each one individually, okay? All right, our first one would be redistribution. Is it up there? No, it's not up there. See, I'm used to my overhead projector. Anybody knows me? I had an overhead projector with transparencies. I've got 2 overhead projectors in my basement with about 1,000 transparencies, but I'm hoping everything comes back, right? So I'm hoping that someday my overheads will come back. I'm not used to this new stuff, but that's okay. Our first thing, which we'll be getting into, would be when we move cash between years. I'm also a tax collector in Cedar Grove. I've been with Cedar Grove 35 years. So anytime, I move cash between years, that's going to require a journal entry. I move cash from 16 to 17, I've got to make that entry in my general ledger, so we'll be getting into that. Transferring to tax overpayments, another non-cash, okay? Taxpayer wants a refund. I've got to make a journal entry for that. Debit the receivable and credit the overpayment account. We'll be seeing that. I also include county board appeals, could increase the levy. I'll be honest, I haven't gotten that many in Township of Cedar Grove where you got a county board judgment increasing the levy. Usually it's decreases, but I threw that in there. How about senior citizen deductions disallowed for 16? Okay, we'll get into that in a minute. When we disallow a senior deduction for 16, need to make a journal entry. And this presentation will be on the GFOA website if it's not up there already. How about disallowing a senior's deduction for 17? Senior can lose their deduction for the current year. We'll get into that in a minute. Need to make journal entries. We're going to be sending the senior a bill for that. Omitted assessments, omitted taxes for 16, need to make an entry for that, right? We'll talk about that in a sec. Added taxes for 17, probably October 25th, we're going to be sending out added and omitted assessment bills, right? We're going to bill those people for individuals that did improvements. Need to make a journal entry for that. Second half levy, okay? Many towns issue, the tax bills for the August and November quarter. Need to set up the tax levy, So all things we need journal entries for. How many people like a good set of journal entries? Good, about 12 and a half people. I don't know if the guy in the back maybe likes half a journal entry. The other thing we'll talk about, estimated tax bills. Okay, we'll get into estimated tax bills in a minute. And my number one increase would be the preliminary tax levy. That's usually my first journal entry in the general ledger, recording the preliminary tax levy for the current year, okay? So hopefully my goal is we kind of go through these. So this is my top 10 increases. Pretty neat, right? These are my increases to the tax levy. Okay, and our first increase would be, make sure it's all up there, to record our preliminary levy. There's a couple places you can get it. You can get it from the field copy of your tax duplicate. The assessor has to give you your duplicate by January 10th each year. Okay, you can probably get the preliminary tax levy right from the 2017 extended duplicate, right? When you got your extended tax duplicate, it'll have in there the preliminary levy for 18. And how many people do get a control report from their tax collector? All right, right from the, it should be more hands than that. We should all be getting a control report from our tax collector. And, on my control report, when I billed 17 taxes, I see 17 billings, okay? And also on my control report for the year 2018, I see what my preliminary levy is on my control report when I billed the second half of 2017. So you can get it from also your control report, okay? And for those 12 and a half people that love journal entries, obviously, we're going to be debiting the receivable. We have offsetting reserves to the receivable. We're very conservative. We don't realize the funds and money until they're actually collected. And as you know, current year tax revenue flows through the amount to be raised by taxation, okay? So my number one increase was the preliminary tax levy. Second increase, big one, gang. How many people do estimated tax bills? All right, look, this is my own opinion. Gang, you have to do estimated tax bills. This is my opinion because, look at what happened this past year. What I do in Cedar Grove, you don't have to follow what I'm doing, recommendation. First meeting in June, I do a resolution authorizing me, the collector, to issue estimated tax bills. It has to be approved by the governing body, okay? And usually first meeting in June, I get approved from the governing body. Within 2 weeks, the estimated bills are out. And then I usually call the County Board of Taxation and I tell them, don't rush and get me a certified rate. They're not going to rush anyhow, because I like to tease with them. There are no rush in Essex County. How many people are in Essex County? I'm not trying to pick on Essex County, but because for some of us, when did you get a tax rate this year? I got a tax rate on July 28th. We had all this school aid that towns were getting, and the schools had to decide what they were going to do with the money, and they didn't want to certify a rate. So gang, if you can get an estimated tax bill out there, get it out there. And then in September, I'll mail out the November bill and the preliminary for next year. And the other thing is, it's happened to me a few times. I'm just interjecting my own experiences from Cedar Grove. Look, this past year when I have to estimate the rate, I estimated too high. Because a lot of times I don't know what the county rate's going to be. It's a guesstimate. I have no idea. That's my big Achilles heel. I just don't know what the county rate. So I estimate like 3.5%, 4% increase with the county. And our rate went down this year for the county, magically. It was fantastic. So that means my estimated rate was higher than what my final rate was. So if you think about it, I collected too much in August, right? So what would happen to the fourth quarter tax bill? It went down. I can't tell you, gang, how many people have come up to me, thank you for reducing my taxes. It's been like a windfall. They're coming up, Bill, thank you for reducing my fourth quarter bill. I don't tell them the hell I overcharged you on the third quarter. They think I'm God. It's like the best thing. All these accolades. You know, nobody understands any of this stuff anyhow. How many people had the last 2 quarters and the first 2 quarters of the next year? Oh, my taxes went up. Well, it's on a calendar year basis. Recommending, gang, if you can do it, this is New Jersey. You know, if you have the ability to issue an estimated bill, get it out there. But again, when I estimate in June, when I send out my estimated bills, got to make the journal entry. Debit the receivable, credit the offsetting reserve. Okay, so recommending, if possible, issue estimated tax bills. You have to do it. And then people go on vacation, they have a bill, they're happy, I'm happy, I overcharged them, everybody's happy. The other thing is second half levy. You know, some communities refuse to do it. They don't want to do the mailing. They don't have staff to put the estimated bills in the envelope. They're worried about postage, the whole 9 yards. You know, the good old days, statutorily, you're supposed to send out your tax bills by June 14th. I know, there was a chuckle back there. Like, they set up these statutory dates that nobody at hell follows. June 14th is the statutory flag date, is when you're supposed to mail your tax bills. We got a certified rate July 28th up in Essex County. But, you know, hey, look, the good old days, traditionally, you know, many communities still will mail out their August, November bill together. That'll be their second half levy. Okay, so if you send out an estimated bill, then I'm just going to make a journal entry for the fourth quarter levy, obviously, in my general ledger. Okay, so there's our journal entry to record the second half levy, debit the receivable, credit again the offsetting reserve. All right? Okay, our next one would be, next increase to our receivable would be, which we're going to be sending out by, I think, either October 24th or 25th, are added assessment bills. Anyone that did any improvements during 2017, we've got to send out an added assessment bill. You know, my assessor comes in every day. Bill, we're up to $11 million. He gives you, you know, it's like the Price is Right. He comes in with these totals every day. How many more toilets he found in town to assess, you know? So he's all excited about the added assessments and this and that. And he gives me a total each day. But again, I'm going to get, you know, a duplicate, if you will, of all of the added assessments. And off the computer system, I'll print out everyone that we billed for 2017. Need to make a journal entry for that. All right, because when the collector's sending out the added assessment bills, I need to make a journal entry for that. Again, debit the receivable, credit the offsetting reserve. You know, no problem with doing that. Also, my number 5 increase would be the omitted assessment bills. Always remember now, when we're generating these added assessment bills, the assessor closes his book on October 1st. So any improvements that were done between the last 3 months of the year, October, November, December, the homeowner's not going to get a bill for that until the following October. That's why usually when I mail out the added and omitted assessment bills, I put in an insert, if you have any questions, please call our assessor, you know. Because a lot of times people call, why am I getting this bill? Well, I don't know what you did, you know, talk to the assessor. So I kind of punt on that a little bit. I found out in practice a lot of the computer systems are different. You know, meaning with my system, you know, when I build the added and omitted, the added assessments are in the 2017 column on my control report. The omitted assessments for the prior year are on the 16 column on my control report. So when I'm making the entry, here I'm doing it in calendar year 2016. I think some of the people that I've talked to that maybe have the Edmunds system has it all just in the current year. The added and omitteds are just in the 2017 year. You'll have to record it that way. You can't just split it up. It's too hard to do. But depending on what system you do have, you might have to either set it up in the 16 calendar year or 17 calendar year. So we'll be making those journal entries next month for the added and omitted assessments. Okay? All right. Our number 6 increase that I do have here would be we need journal entries for disallowing senior citizen deductions. We realize that a senior citizen, if they make application, can get $250 off their taxes. Okay? But for the current year, senior citizen deductions could very well be disallowed. Meaning, and the two common instances where we would disallow a senior deduction for the current year would be if the senior citizen sells their property. If they sell their property, we get a deed in, we know the deed date, and we do have to prorate, we have to do a proration of the disallowance. So if the senior sold their house today on September 28th, we would have to do a proration. We would disallow the prorated. There's a chart that the collectors follow to give them the prorated total. They don't have to put it in the adding machine at all. They would know, okay, $100 has to be disallowed. We've got to send a bill to the new owner. So the new owner's going to pay that prorated share of the disallowance. Needs a journal entry. I've got to set up that $100 charge on my tax screen, okay? So if you had, normally disallowing for the current year would be either one, senior sells during the current year, or the other situation I've seen all the time in practice is senior citizen died last year in 2016. I don't know about it. And that senior deduction of $250 is in the duplicate for 2017. Has to be disallowed. If the senior dies in the prior year and the deduction is still in the duplicate for 17 because you just didn't know about it, you have to disallow the deduction and send a bill to the new owner. Well, if they haven't sold it, would send to the estate, if you will, okay? So usually disallowing for 17, the current year, common situations would be proration of the senior citizen deduction, or I find out through, which we'll get in a second, we'll talk about the post-annual year tax statement, that I find that the senior died in 16, and they're still in the tax duplicate for 17, need to do need to bill the new owner and need to make this journal entry. Now, granted, we're debiting the receivable, and ultimately, this goes back to the state of New Jersey, right? That's why I have due to from state of New Jersey, because many times in your general ledger, you'll have one page, due to from state of New Jersey. If it ends up as a debit, it's a due from. If it ends up as a credit, it's a due to. So we wouldn't have like one general ledger page for due from and another one for due to. So that's why I have that labeled as, due to and due from state of New Jersey. Okay? So that would be another way with debiting the receivable, and ultimately we're going to be sending this money back to the state, and we'll talk about that in a little bit. All debits to our receivable. Okay? How about number 7? We can have a senior deduction disallowed for 2016, for the prior year. Okay, let's say we're in 2017. What happens every January, gang, whether you know it or not, the tax collector has to send to the senior citizen a post-annual year tax statement. It goes to the senior in January. It's due back to the collector, me, by March 1st. And we send this form to the collector, to the senior citizen, because we're asking them, what was your income for the prior year? What was your income? If their income was under $10,000, excluding Social Security, they would be still entitled to the deduction, okay? And the other thing is, we need this post-annual year tax statement returned to the tax collector. So when it would be disallowed for the prior year, a senior deduction would be if the senior citizen didn't send back the post-annual year tax statement, okay, because they have to indicate what their income was for the prior year. If we don't get that statement from the senior, it's disallowed, okay? Anytime we disallow the deduction, we give them a form so they can appeal it to the County Board of Taxation, okay? They can appeal our decision. And if their income level was over $10,000 for the prior year. Now, many times seniors come up to me. A senior came up to me last week. Oh, I just did a scratch-off. I won $20,000. You shouldn't have told me that. Because I made note oh, you won $20,000. That means you're going to lose your senior deduction for this year, So I make notes in my file. A lot of people tell me they had a home run, they did this, they did that, a lot of income. But all my seniors are honest in Cedar Grove. They put down their accurate income, on the post-annual year tax statement. But I know I don't know how many collectors here, but the post-annual year tax statement is a dog. It's really a dog to deal with because you've got to get this back from seniors. I love my parents, but, you know, they get the form and there's boxes you have to check off. My parents check off all the boxes. Mom, you can't check off all these boxes. You got to pick one box. Well, I don't know what I'm doing. I know you don't know what you're doing. So let me try to help you out. But here, you know, if it's disallowed, so everybody's okay with that, we could disallow a senior deduction for the prior year, non-return of the post-annual year tax statement, or their income level is over for $10,000 for the prior year. You know, maybe they took money out of their IRAs. That's taxable. Anything that goes through their federal tax return, that's going against the $10,000 threshold, excluding Social Security. And there's a couple other exclusions either. But here we're debiting the receivable, we're debiting budget operations, because when we debit operations, is that going to increase or decrease surplus? Decrease. So we're debiting operations, which would decrease. When the cash comes in, we'll debit cash, credit the receivable, and then we'll adjust the reserve to agree with the receivable by debiting the reserve and crediting receipts from delinquent taxes. So anytime we increase a revenue account, which is receipts from delinquent, that increases surplus. So the net effect to fund balance is zero here because we debited operations, and then when the cash comes in, it's going to go through our revenue account, receipts from delinquent taxes. So the offset to fund balance is zero, which we want, but obviously we're going to set this up as a due to back to the state of New Jersey, okay? Because the state wants this money back. When we disallow these senior deductions, okay, they ultimately want it back. And we'll talk about how they get their money back in a little bit. Okay, so again, that's another debit to our receivable. These are all debits to the receivables. We're increasing our receivables. Okay, another one would be, I haven't had that many instances with this. How many people have gotten county board judgments increasing taxes? Okay, a few of you. I think I had one or two in Cedar Grove in all my years. But just be aware, we'll talk about the decreases in a little bit, but you can get a county board judgment increasing the levy. So if that happens, debit the receivable, credit the offsetting reserve. Okay? All right. Number 9 would be, other increase would be, how about transferring to tax overpayments? You know, how many times? I'm the tax collector and the CFO, so I don't have to argue. I don't have to chase anybody. I do both jobs in Cedar Grove. One of the important things that I do, good internal control procedure, if I'm going to refund money back to a homeowner, okay, I'm going to do it by voucher, issue them a refund, I immediately go to my tax screen and take that credit off the tax screen, okay? Bring it back down to zero because I don't want that overpayment there anymore because I'm giving the money back. So I need to make a journal entry for that. And each one of these adjustments, gang, I'm sure with your computer systems, if you give it a code on your control report, you'll see all of these non-cash items on your control report. Off that, you can make the journal entries on a monthly basis. Easy. Once you get a system, it's a piece of cake. It really is that easy. Also at year end, you know, a year-end receivable has to be a true receivable at year end. You know, a lot of times we're posting cash to our receivable as the year goes on. There could be duplicate payments buried in there, posted against the receivable. At year end, we need to come up with a true receivable in our financial statements. So at year end, any of my credits against the receivable, all my overpayments at year end, I move to an overpayment account. So I'm debiting the receivable, crediting tax overpayments. Once it's in tax overpayments, what are you going to do with it? Either we're going to refund it back to the homeowner, maybe cancel it by resolution if we can't find the person or they're ignoring us, or apply it to a subsequent tax quarter, okay? So we're going to try to, we've got to move these overpayments to an overpayment account, okay? Should have no disbursements against your receivable, right? Because even if you're going to refund it back to the homeowner, we make the journal entry, and then when you have the cash entry, credit cash, debit overpayments. There should be no disbursements against your general ledger page for taxes receivable. All the disbursements should be against tax overpayments, okay? And I think my last increase is many times moving cash between years. How many times in practice my staff comes to me, Bill, I inadvertently posted this receipt last month to 2016, and I need to move the cash to 2017. And even what I've been doing, and maybe it's just my procedure, any adjustments I need to do non-cash, I'm usually making the adjustments. I don't have my staff do it, I do it, so I have better control over any of the adjustments that have been made to the receivable. So usually they'll tell me, Bill, I posted this to the fourth quarter of 16, it really should go to 17, first quarter. Can you move that cash? So we need to make, anytime we move cash between years, gang, we need to make journal entries for that. So here, if we're transferring cash posting from 16 to 17, okay, we'll debit the 16 receivable and credit 17 receivable, okay? So these were my top 10 increases to the levy, all right? I thought they were pretty cool, right? Maybe it's just me, okay? Now we'll get into, how about we get into our top 10 decreases to the levy? All right, those were all increases to the levy, increases to the receivable. Now how about we get into all of the decreases to our tax levy? These are my top 10 decreases. Obviously, redistribution of cash between years, because 1 year would be increase, 1 year decrease, so I kind of kept that one into my decrease side. Okay. How about when we apply a tax overpayment to the receivable, right? Homeowner says, don't give me the money back, apply it to my next tax quarter. You'll be seeing, well, debiting overpayments, crediting the receivable, okay? These are all credits to the receivable. Okay, transfer to foreclosed property, I threw that in there. Many times, if it's in tax title liens, which is a receivable, once the town forecloses on it, it comes out of tax title liens and it goes into property acquired for taxes. I haven't had any of those situations in Cedar Grove, but it's something you should be aware of, and we'll talk about that in a minute. These are all my decreases. How about when we transfer to tax title liens? Okay, we'll talk about that in a minute. You got to know after your tax sale what liens were struck off to the municipality because they're no longer in prior taxes receivable. It's now a tax title lien. It's a municipally held lien. So anything transferred to tax title liens, need journal entries for. That'll be decreasing the prior receivable. Cancel by resolution. Governing body can cancel taxes by resolution. We'll talk about that. A couple of situations that I've run into. County Board tax appeals, okay? We had the increase side. The ones that we mainly see are the decreases, right? For County Board judgments, we're going to be reducing somebody's tax levy by that County Board judgment. Need journal entries to record that deduction or reduction. How about veteran deductions per the duplicate? How many people, you should all go visit your tax office, go look in the tax duplicate. You'll see the veteran deductions per the duplicate. Need to make a journal entry for that. And also, the senior deductions per the duplicate. Need to make that. Go look at the tax duplicate. Right in one of the first few pages there, you'll see the seniors and veterans, widow vets, seniors, disabled persons, surviving spouses, all listed in the tax duplicate. Need to make journal entries for that. Veteran deductions that are allowed for the current year, need to make a journal entry for that. Just realize that, if there's no deduction in the duplicate for 2017, veteran can still come in and make application for the current year. As long as they meet all the qualifications, they would be entitled to the deduction. We would reduce their tax levy by $250 and/or the senior deduction, okay? Even though the senior is not in the tax duplicate for 2017, senior can come in and make application, and if they meet all the qualifications, they would have $250 off their taxes, okay? Okay, now we're on to the decrease side. Okay, senior deduction approved by the tax collector, okay? For probably I should put there 2017, allowed in 2017. This is where a senior comes in and makes application for 2017, okay? As you probably know, just putting on tax collector's cap, there can only be one senior deduction on a parcel of property. Husband and wife are seniors, only one senior deduction, okay? There can only be one senior deduction on a particular parcel of property. So if the senior deduction's not in the duplicate for this year, they come in and make application, meet all the qualifications for 17, we got to make a journal entry. Debit, due from state of New Jersey, because we want to get this money back from the state. See, any of these senior deductions, veteran deductions, we get reimbursed from the state. We'll talk about that in a few minutes. Okay, we get reimbursed from that. That's why we're debiting the receivable from the state. And we're going in, and I'll go in and reduce their fourth quarter bill by $250. Okay? So as long as there's not an overpayment yet, I'm just going to reduce their tax bill. So we need to make a journal entry for that. All right? For seniors being allowed for 17. Okay? You can also get veteran deductions allowed for the current year. If they're not in the tax duplicate for 2017, a veteran can come in and make application. And again, the general rule, if anyone's taking the tax collecting courses, any veteran that is on the deed can come in and make application. If the husband's a vet, the wife's a vet, they can both come in and make application and get the deduction. If they have 3 kids and they're all veterans and they're all on the deed, they can all come in and make application and get the veteran deduction. With the seniors, there can only be one senior deduction, $250. Veterans could be different. Who's ever on the deed and is also a vet, meets the qualifications, they can get the deduction. You know, and it even goes further. Let's just say the spouse passes away. The husband, who is a vet, can also make application for a widower of a vet. So there's a lot to it. You know, there's a lot more latitude with the veteran deductions. So just be aware that, you know, if they meet the qualifications, they can get the deduction. The important thing that I always get a lot of times in practice, if they fell asleep for 10 years and didn't come in for the deduction, there is no retroactive effect. Many of them come in and say, oh, Bill, $250, I didn't apply for the last 10 years, you owe me $2,500. You know, there's only one, they only can come in for the current year. So if they're coming in for 17, there is no retroactive effect. If they fell asleep, we try to put it up on a website, try to let people know, come in and make application. You know, we have a seniors group and we try to let them know some of the benefits that they could very well be entitled to. You know, and they have to meet some of the wartime service periods and whatnot on the application, you know. So sometimes they don't meet the wartime service periods, they might not get it. So again, debiting due from state and crediting our current year taxes receivable, reducing their fourth quarter bill by that amount, okay? Our other decrease to the levy would be the senior citizen deductions per the duplicate. Need to make a journal entry for that. You know, I usually make that entry after we do my fourth quarter billing in Cedar Grove. I'll make the entry for the senior deductions per the duplicate, debit due from state for the senior deductions, credit the current year taxes receivable. Again, when we had the increases, we're always journalizing the gross tax levy, not the net levy. We're always showing the gross levy in our duplicate, in our general ledger, and then the senior deductions, which we get reimbursed from the state, we'll make a separate entry for that. And again, just always, maybe as a good idea for the CFOs out there, you know, the way we get our money back from the state is the collector does a report to the County Board of Taxation. They have to file it usually by June 5th. And then we get the money by November 1st, ACH credited to our account. And usually we get a 2% administrative fee on top of that. So usually I would recommend to you as CFOs, early June, ask your collector for the senior citizen and veteran report that they file with the County Board of Taxation. Because then come November, you can add up those two amounts, add 2%, and just verify that to the amount that you're getting on November 1st. So it doesn't have to be a guessing game. Ask your collector for the senior citizen and vet report that they file in early June. Okay, so I always pull it out and verify it. You know, add them two together. Okay, our other increase would be the veterans, obviously, per the duplicate. And if you looked at your tax duplicate, there would be widow of a vet and a veteran listed in your tax duplicate. You need to make a journal entry for that. Again, setting up the receivable due from state, reducing the current year taxes receivable for that, and again, the cash would come in usually on November 1st, okay? And when the cash comes in, debit cash, credit the due from state, that little 2% piece that we get, the administrative fee, just pick up as Myrna. That's kind of what I've been doing with that, okay? So that kind of covers the senior citizen and veterans at this point, as, again, reducing our receivables. How about county board judgments? I think we all get county board judgments into our office. You know, some internal control procedures that I do in Cedar Grove, once I get that county board judgment in, first thing I do with it, I go find my assessor, Rich. Rich, I want you, every judgment that I have in my office is initialed and dated by our assessor. Gang, I could show you judgments with transposition errors on it, easily. People make mistakes. I verified the dollar amount on the judgment with our assessor. Is this the right amount of the reduction? You know, did the county, look, I used to be an auditor for 6 years, so I verify everything. Not that I don't trust, I just want to verify. So Rich will sign off on the adjustment, on the judgment. Somebody's taxes will go down $1,000. So then what I'll do is I'll go to my tax screen and reduce their fourth quarter bill by $1,000. Usually once you get that judgment in, the next thing that happens, gang, in practice is you get a letter from the attorney. Please send me the tax reduction. So I write him a letter back saying, there's no refund until there's an overpayment. So all I do is I take a picture of the screen and I send them a copy of the taxpayer's screen, showing that I reduced their fourth quarter tax bill by $1,000. These attorneys, all they want is their money. You know what I mean? So, hey, they're entitled to it, I understand it, but there's only time, in gang, there's only way we refund money is when there's an overpayment. You know, I didn't get into state tax court judgments here, but I get state tax court judgments where you have to do a refund. I make sure that water and sewer's up to date. You don't want to see delinquencies on the account and refund money. We've had Burger King in Cedar Grove. Well, I had to refund money for taxes. They weren't paying their water and sewer bill. So I took some of that tax refund money and applied against their water and sewer delinquencies. So don't refund money if there's still monies owed by the taxpayer. That's what I'm trying to highlight. But the attorneys, they want their money. I said, and I just sent them a snapshot of the screen. This is where I made the adjustment on the fourth quarter. And go chase your client for the money. I put it professionally, though, but, you know, that's kind of what I do. But, again, anytime when we have a judgment here, we got to reduce the receivable, credit the receivable, debit the reserve. We're just kind of going in the opposite direction, okay? We just, whoops, what am I hitting? There's too many buttons on this thing here. It makes me nervous. Okay, doing good? We're doing good. Okay. Resolutions. The governing body can pass a resolution canceling taxes. You know, we've done it a few times. We've had some property that was deeded to the township where there was a receivable on it. You know, we have Morgan's Farm. It's hard to believe in Little Cedar Grove. In Essex County, we have a farm, dedicated farmland, little farm in Cedar Grove. There was taxes delinquent. We passed a resolution canceling it. Okay? You know, where are we going to collect it? The governing body approved it. Many times we'll cancel taxes for probably two other instances. A couple years ago, we did a reval. I mean, we all go through revaluations. What's kind of silly with the reval process is, this is my own opinion, you know, the homeowner gets that card in the mail, tells them what their assessment is. They don't pay any attention to it. The only way they wake up is when they get a tax bill. The deadline for appealing when you have a reval is May 1st. Okay, so May 1st is the deadline. They get their August tax bill, and they realize the town made an error in the assessment process. It was way too high. Well, they can't appeal anymore because this is August. They got their bills already. And they had to appeal it back in May. So there's been instances where the governing body, we made gross errors on some assessments in the reval. Just mistakes. We can't have this person pay $13,000 when it should be paying $8,000. So we canceled $5,000. Granted, the town's going to have to eat the school piece. We made a mistake. How many people get into disabled vets where they apply for the exemption? How many people get veteran exemptions? 100% totally permanently disabled. They get a letter from the VA administration. They come into your community, make application with the assessor, and now they're looking for total exemption. So I'll do a proration. The assessor will approve it. We'll do a proration from the date of application. So when I'm reducing their tax bill by $2,000 or $3,000 for that exemption, I'm doing a resolution for that. So there'll be resolutions where I'm reducing someone's taxes over and above what's the county board judgment, if you will, okay? Again, what we're doing here is crediting the receivable, debiting the reserve for the receivable, okay? So these are all things that we're doing, you know, on a monthly basis, needing journal entries. We want our general ledger to be a mirror image of the tax collector's control report. Dollar amount should match at the end of every single month. If you got that system going, gang, you'll have no problem. Auditors come in, boom, you get them out. They'll be happy. That's what it's all about, right? Okay, let's talk about now transferring to tax title liens. Let's talk about tax title liens a little bit, okay? This first journal entry would be, always remember, important, gang, when there's a municipal lien on a piece of property, and the way the municipal lien got there was property went up on tax sale, nobody bid on it. It got struck off to the municipality. The town is the holder of the municipal lien certificate. Always remember that all subsequent charges accrue to the municipally held tax title lien certificate. Everything accrues. So once it's a municipal lien, that property's not going up on tax sale again, okay? So all subsequent taxes accrue to the certificate. So here what we have to do is we have to make a journal entry pulling it out of current year taxes, 2017 taxes, by crediting it, and debiting tax title liens. The taxes have accrued to the municipally held tax title lien certificate, okay? So that's kind of, I probably have, you know, maybe 6 municipal liens. They're like, I call them garbage pieces of property, little strips. I don't know why when they did the tax maps, they just didn't attach it to somebody's property. No one bids on them because you can't build anything on it, you know? So I have about 6 that I need to make this journal entry. Current year taxes have accrued to the municipally held tax title lien certificate, okay? So that's why we're crediting the current year taxes, debiting tax title liens, okay? The other entry that we need to make is that you have to be on top of this, gang, is after the tax sale. Usually many times in practice, all our liens are sold. I'm up in Cedar Grove, all my liens sell. Water, sewer, they buy everything. It's crazy. I got a water lien for $123. I don't know what they're going to make on it, but they'll buy it, and they're bidding premiums for $123 water lien. It's crazy. But important, though, we need journal entries after the tax sale when liens are struck off to the municipality, because no longer is it considered a 2016 taxes receivable. It's now a tax title lien. All we're really doing is reclassifying the receivable, right? So just be on top of it after your tax sale. I would even recommend go in and sit. How many people attend their tax sale? You know, I go in. I try to invite all my department directors in. I invite the town manager. Hey, it's a fun morning. It's a fun morning. I always do my tax sale. It's always on December 7th, Pearl Harbor Day. It's on a Thursday this year. So that's always kind of the day. It's a fun day. People are coming in. They're all fired up that morning. So important thing is here, gang, just realize that after our tax sale, anything that's struck off to the municipality, we need to make journal entries for it. Take it out of the prior year taxes receivable and move it to tax title liens, okay? Okay, number 8 here would be transferring to foreclosed property. And I'm sure some of the bigger municipalities, we haven't done this in Cedar Grove, but just realize, once it's in tax title liens, just don't leave it there forever. You know, the municipality has the option 6 months after the date of sale to foreclose on this property and try and get these properties back on the tax records, okay? Once you foreclose on your tax title liens, we need to make journal entries. It comes out of tax title liens by crediting it, and we debit this account called property acquired for taxes. And when we debit it, it's based on the assessed valuation of the property. So hopefully at some point we can get these properties back on our tax rolls by auctioning them off. So just be aware of that. I haven't gone through this in practice because luckily I've been fortunate enough to, you know, sell our liens. And if possible, you can try to, I get calls, people looking to have us assign some of municipal liens to an outside buyer. Municipality can also assign their municipal liens. Because really, with a tax title lien, obviously you just have a piece of paper in your vault. You'd much rather have the money. That's what it's all about. Okay, let's see. Number 9, how are we doing with time? We're doing good. Okay. Our next one would be decreasing the receivable. How about transfer tax overpayments per our overpayment list to the receivable? I mentioned this a little bit earlier, where you have your listing of tax overpayments each year, and I notify the property owner. They say, "Do you want your money back? Sign the voucher. We'll refund it." They say, "Don't give me the money back. Apply it to my November tax quarter." So I'm going to take that $2,000 or $3,000. I'll go to their tax account. I'll put that credit on their fourth quarter bill, okay? I'm moving the cash from overpayments to their account. I need to make a journal entry for that, okay? And when I do that, I gave it a code. I'll see that on my control report. Need to make an entry. Debit overpayments, credit 2017 taxes receivable, okay? And my last decrease here, gang, is pretty fun, right? I got a kick out of it. Our last decrease would be, again, moving cash between years, okay? In fact, I did one last week. I'm planning on, my tax sale is going to be December 7th. I have to prepare my tax sale list 50 days prior to the sale date, which would be about third week of October. So I'm trying to get people, I'm sending out delinquent notices for water and sewer for 16 and taxes for 16. And I had one property that had, for whatever reason, squirrely things happen in practice. They owed $1.23 for the third quarter of 16. Everything else is paid. I had $1.23. I don't know how that happened. So I moved $1.23 from their August quarter of 17 to their third quarter of 16. I moved $1.23 back to clear up that delinquency. I shouldn't have $1.23 there sitting in the third quarter of 16, and everything else is paid. So So I just moved money from 17 to 16 to $1.23. So when I did that, need a journal entry. So anytime we're moving cash from, let's say, 17 taxes receivable to the prior year, moving cash, because the cash was posted initially to 17 in your general ledger. If you're going to move that cash on your screen to 16, you need to make a journal entry for it, okay? So that's what I was trying to accomplish with each one of these. My top 10 increases and decreases. I was hoping this would get on the David Letterman show, but not there. But I think I'm just about, 9:20. Any questions? 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 Any questions? Go ahead. Go ahead. Why don't you use the mic, Kathy?
I'm sorry, I'm not a tax collector.
That's all right.
Two questions. When you're doing a journal entry to move from, say, 17 to 16 taxes, do you get a council resolution for that before you do it?
No, I just do it. I just make the, they have enough of resolutions at times. I just move it from 17 to 16, just make the adjustment, and don't do it by resolution. I don't do it by resolution.
Second question. We've had a couple of people lately, the spouse, one spouse died, the other one comes in, the refund check was issued to both spouses. In both cases that we got, we were able to prove that the spouse that was still living was the one that was entitled to the refund. Do you ever get into worrying about, okay, it was a refund, say for an overpayment, worrying about the one spouse died, and is the spouse that left, is she entitled to the whole house, or did the other half
I don't
go
really
to
get
someone
into
else?
that. If the two spouses are on the deed, the one that's living, I'll make the check payable to the one that's living.
Okay, so you don't worry about that.
Don't worry about it. Don't get concerned. And if both have passed away, I'll type on the check the estate of. I'll put the estate of on the check. So I don't really get too involved with, got enough of concerns in practice as far as one of the spouses living, you're on the deed, I'll send you the money, okay? In fact, we have John Sezzi in our town, just passed, he was the only person. You know, I put the estate of on the check, you know? So that's the way I'll do that. Okay, any other questions? Yes, Larry, come on up. Would you get dressed today? What the hell's going on? You had shorts yesterday. Would you go to the store?
I actually read my emails, Bill. And
Mine's up in a cloud. I'm trying to get an air balloon. You know, they wanted me to go up in a cloud, but I got an air balloon on Craigslist. Yeah.
You make me pose a question. It may be crazy, but
Nothing's crazy.
In the town I live in, third quarter estimated tax bills are becoming almost predictable every year.
You have to be.
I understand that. What bugs me is I used to be administrator of the town, and I know how much it costs to get that out.
Right, for postage.
Exactly.
And somebody,
handling and
and
somebody's
printing the
time.
bill. I know, it's the price of doing business.
Is there anything that prevents you when you issue the final tax bill for the year, which will be the fourth quarter and the first and second of next year, is there anything that prevents you from getting permission to get a estimated third quarter bill for 2018 now, put that in your pocket, and just when you send out the fourth quarter, first and second quarter, also put out a third quarter estimated tax.
Yeah, I don't think statutorily they're going to allow you to do that at this point. They're not going to be that far ahead of the game. And really, gang, so I would say no, Gary, you can't go that far into 18 at this point.
But do you know?
Huh?
But do you know?
I don't think statutorily you can do it.
I'll check it out. I'll let you know.
You know what? Send me an email, but put it through the cloud, all right? I'll have to learn how to download it. Yeah, send me a transparency. I have overheads in my basement. But, you know, there's costs with the estimated tax bills. I know that. You know, for the mailing, somebody's got to stuff it. But that might be the cost, but think of the real plus sides. You got cash coming in. You can pay the school and county when they need it. You can meet payrolls. You got people going on vacation that they're not bugging you that, where's my bill? And tell me I can't send it because I don't have a certified rate. Our bills are out. And the thing that drives me nuts, Larry, as a tax collector, if you don't do estimated bills, let's say theoretically, this year we got a certified rate July 28th. I know some towns, my parents live My parents live in Woodridge, Bergen County. They got their bill like, I think August 21st, something around there. Now the town has to give them 25 days from the date that the bills go out to make payment. Now the payment date is now sometime in September. Now, how do you explain this to the property owner? Now they have a due date sometime in September. If they come in 1 day late, the interest reverts back to the statutory due date of August 1st. So now if they come in 1 day late past, let's say September 10th, they come in the 11th, they don't owe you 1 day's interest, they owe you 6 weeks worth of interest. So that's the real negative part with these, by not getting an estimated bill. You've got to give them 25. Come on up, Larry. Did you send me that email already? I can check it on his computer, I think.
You didn't answer.
What's that?
You didn't answer the email.
Yeah, I know.
No, I want you to know I'm not objecting to the estimated tax bill.
No.
I'm trying to save the costs of doing it next year by anticipating and doing it when I get out my first and second
Yeah,
quarter.
well, I think a lot of times is you've got to estimate a tax rate. You don't even have a tax rate this year.
When I send out my fourth quarter and first and second of next year, I already know what my estimated bill will be for next year.
Yeah.
I know it now as well as I will know it next June.
No, hey, it's a great idea. It's a great idea. Why not put out some estimate maybe now for that third quarter, rather than billing? Because right now, statutorily, your first and second quarter of 18 is based on 1/2 of the 17 levy. It's a great idea, Larry. Maybe Tim Cunningham was here yesterday. Maybe you can, maybe we can talk. It's a good idea, Larry. It's a good idea. No, it would save on postage and everything else. All right. Any other questions? Well, hopefully you got something out of this seminar. A little bit journal entries, some non-cash. It's a lot of fun. Thank you.